Good afternoon, everyone. It's really a pleasure to be with you this afternoon. I published an article on the Skaffold blog about a month back, it was, and basically described the performance of mine and my wife's self-managed super fund. If you've read the article, or if you haven't, you're more than welcome to. If you have read it, I guess the thing that stands out is that at the time of writing, we had a return of 110%, which, needless to say, we were quite happy with. The way this came about, I was having a conversation with Skaffold's chairman, who's Roger Montgomery, and he was asking me how do I go about finding opportunities in Skaffold personally, and how have I gone with that. And I said, well, yeah, actually, I do indeed use Skaffold personally, and I've actually managed to do quite well with my self-managed super fund, which I set up about a year ago. And so he challenged me and said, well, why don't you write a blog post and transparently describe how you've gone about doing that? Now, at first, to be honest, I was a little bit uncomfortable with sticking my personal financial situation out there on the internet for all to see, but I figured, well, why not? Obviously, Ironfold's general manager, I certainly should believe in it, and I very much do. And so I wrote the article and just basically described step by step how I'd gone about investing the equities component of my self-managed super fund. Now, it's important just to say from the outset that my approach will be very different to the approach that a lot of people will use. I had a very concentrated approach. I'm someone who doesn't mind a fair bit of risk. I've got a very long-term perspective with my super fund because I'm relatively young still, so I won't be accessing it for quite some time. And so with that in mind, I can afford to take a few risks. Also, of course, the decisions that I made and the transactions that I undertook, things have changed since that time. So anything that I did back then is not necessarily a recommendation to do something similar today. But what I thought I'd do, I'll just quickly talk you through the article that I wrote for the blog. So the first stock that I bought was Flight Centre. And I bought Flight Centre in May of last year. So I'll just pull it up on the screen here, and I'll go straight to the Skaffold line. Now, one thing you can do with Skaffold, which is really handy, is you can zoom in on the particular part of the chart that you want to look at. So I'll just grab this slider bar here. And so this is Flight Centre's price and value chart. I'm just going to zoom in on the last 12 months or so. So I bought in May, which was around about here. And as you can see, was very fortunate to more or less get in at the low point for that stock. I bought it in 1975, and I'm still holding that position. And you can do the math, it's well and truly doubled since then. So the next stock I bought was Codan, but I bought Codan back in August of last year when it was trading at $1.47. It then rallied quite strongly. So you can see, again, I'll zoom it in. You can see that I bought it, where are we? Somewhere around here. And it then went sky high. I actually decided to sell round about here at $2.65. And so I missed the latter part of that rally. But the way I approach these things is I have a fairly defined process, and I really try and stick to it. One of the things I've learnt over the years, and I've been in the markets now for pushing 20 years, is that it's really important to have a strategy, and it's then extra important to stick to it. And to be honest, sticking to that strategy is more important than what the strategy is. People who can apply a disciplined approach to their investing will usually end up in the long run with a more positive outcome. So I sold, and the reason I sold was because the valuation at the time was less, the future valuation, the 2014 valuation, was less than the price that it was trading at. Incidentally, as you can see, and if you've been following this stock Codan at all, it fell off a cliff in the last week or two. And I decided that the market had overreacted, and I bought some more last week. My reasoning for that was that it's now trading at a significant discount, in particular to this 2014 financial year forecast. And as you know, we're only a week away from the 2014 financial year beginning. So the more relevant safety margin is this distance between the 2014 valuation line, and indeed that safety margin that we've got showing there of 70% will change to be something of the order of 57% from next week once we're into the new financial year. So I looked at that. I also looked at the fact that the value is forecast to rise from 2014 onward, and I decided that I'd venture back in to Codan. Now, it'd be lovely if it had a quick turnaround and went back up to those sorts of levels we were looking at a few months back. But of course, the realistic side of me is not expecting that to occur. The next stock I bought was EAX, Energy Action Group. Now, at the time I bought EAX, it wasn't covered by any analysts, but it was trading at a significant discount to its intrinsic value. Now, I bought it in October at around $2.40, somewhere around this sort of level. And I sold it not too long after in February. And the reason I sold was that the price was then exceeding the value. It had rallied up to around the $3 sort of mark. And I sold it at just over $3. So, I'd originally bought that one with a long-term view, but it rallied so quickly and got up above its value so quickly that I decided it was time just to take a profit. Then the final one that I added to my portfolio was SST, Steamships Trading Company. Now, Steamships Trading is an interesting little company. It's primarily listed in, it does have a listing in Papua New Guinea, but it's primarily based, its operations are in Papua New Guinea. It's a logistics company. It's very illiquid. It trades maybe twice a week on a busy week. So you have to have a lot of patience and a long time frame if you're looking at a stock like this. But those are not a problem for myself. It is a lot higher risk. There are no analysts covering the stock. It's based in an emerging market. As I said, very low liquidity. It's a stock that I've kind of kept an eye on for many years, and over the years it has performed quite well. One thing that I liked about this particular stock, if you look at the history of the Skaffold scores, it's generally been pretty consistent. A1 at times, A2 at other times. A little bit of a dip in 2009, and then it started to recover in 2010. As I'm sure you're aware, most businesses had a dip in 2009, so that's not unusual. So I decided to venture into this one. Now, I bought it at $31. It rallied up to $40, and that's about the time when I wrote my blog article, and I was feeling pretty chuffed. It's since come all the way back. I bought some more in that price fall, and then it's fallen even further beyond that. So it's actually in negative territory for me at the moment, but I'm just going to sit tight for the time being. So when I wrote the article, it was showing a return of 110% or 113 if you include dividends. Now I'm sure you're thinking, yeah, that was in May. The market's come off a lot since then, and yep, absolutely true. My performance is nowhere near what it was, but it's still 83%, including dividends, which is not too shabby for a bit over a year. So I'm still pretty happy with that. The decline is primarily due to Steamships Trading Company, which is down around about the $25 mark now. Flight Centre has held up quite well, and well, I've only just bought back into Codan, so we'll see how that goes. So I just thought I'd give you that bit of an overview of how I have used Skaffold in a personal capacity, and I guess the result speaks for itself. Obviously, it's only a short period of time, so you shouldn't be jumping to any conclusions. I'm realistic enough to not have anything like that sort of expectation for the coming year. If I do 10 or 15%, I'll be very happy. But you can see, I hope you can see how Skaffold can be used as a tool to find these opportunities, and it really does highlight to you where the opportunities lie.